A common question for saving, investing, and withdrawing for retirement is how much should I save or withdraw? But just as important is where do you save, invest, and withdraw? What type of account should you use? So today we're going to unpack what type of retirement accounts should you be using, focusing on 401ks, after-tax 401ks, Roth and Roth IRAs. Let's chop. Every year, you can get up to $77,500 in your employer-based retirement accounts. But which ones should you use and how should you use it? So today, we're going to discuss your after-tax 401k, your Roth 401ks, and how do Roth IRAs and traditional IRAs play into all of that? Pros and cons, common mistakes. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. And if you like what you see, feel, and hear on the show, as always, like and subscribe so you won't miss the show, and share with your family, friends, and colleagues. All right, let's chop. We are going to break down all your retirement accounts at your employer and your IRAs outside of your employer and see which kind of strategies is best for you high income earners out there. So let's dive right into understanding the basics of Roth 401ks, your regular 401k, IRAs, and Roth IRAs. Let's start with a general explanation of retirement accounts in general, both your employer-based and your IRAs. It's about saving, investing for retirement, withdrawing from retirement, and also getting a tax benefit for that action. Now, certain accounts have different tax benefits than others. So here's the gist. With your non-Roth IRA or 401ks, you get a tax deduction for your contribution to your traditional IRAs based on income limits and your 401ks up front. So it reduces your annual tax obligation per year. Then you get a tax deferral in the middle while your account is hopefully growing over time. And then you are taxed on the withdrawal at ordinary income rates for those non-Roth IRA, non-Roth 401ks. Now, when you're talking about Roth 401k and Roth IRA, you are not getting a tax deduction for your contribution into those accounts. That's the main difference at the front. Then you get tax deferral in the middle if hopefully your account is growing over time. And then with Roth IRA, Roth 401ks, you are getting a tax-free distribution when you withdraw for your retirement income out of that account. So those are the big differences. Now, there's a couple of nuances in there, and we will talk about that across the segments of the show. So let's start with your regular IRAs and your regular 401ks, right? So with your traditional IRA, participate in a traditional IRA, you have to meet certain income limits. And once you pass the income thresholds, you will no longer get a deduction for your contribution into a traditional IRA. And with that traditional IRA, if you are able to participate, then you get a tax deferral in the middle, and then you are taxed on ordinary income on the end. All right. Now, for traditional IRAs, there's also a contribution limit. So for 2025, those contribution limits are $7,000. And if you are 50 or above, then you have an additional $1,000 called a catch-up that you can contribute to, bringing your total to $8,000. So one of the biggest difference between the IRAs and the 401ks are the contribution limits and the income participation limits, right? With a traditional IRA, again, you get a deduction for the contribution if you don't pass through income thresholds. Now, for a non-traditional IRA, then you can contribute to an IRA all day long. You just won't get a deduction for that contribution. Again, your contributions grow tax-free in the middle. And then with a non-traditional IRA, you have paid tax on some of your contribution and not on others. So when that income gets distributed for retirement, you will pay a pro rata a tax. So the portion that you contributed to after tax, you've already paid tax on it once. You won't get taxed on that. However, whatever gains that you have not paid tax on, that will come out as ordinary income. Another key characteristic of traditional and non-traditional IRAs are being susceptible to required minimum distributions, or short RMD. When you reach the age of 73, the IRS tax code says that you must take a required minimum distribution out of your IRAs. And if you don't, then you are assigned a penalty for not doing so. So the reason for these RMDs is that the government wants their money at some point, right? So if you received a tax deduction for the contribution up front, then you've received a tax benefit. You have tax deferral in the middle while your account is growing over time. And then at some point, if you don't take a distribution, then the government hasn't collected their tax. So they're saying, okay, after a while, specifically age 73, we are going to require that you take a distribution so the government can collect its tax revenues. That's the reason for the requirement minimum distribution. So now let's pivot to your employer-based 401k. So with your 401k, traditional 401k, you get a tax deduction for your contribution to your 401k. So it's before tax. It's called a salary deferral. All right. You can defer up to $23,500 into your 401k pre-tax, and then you can contribute another $7,500 if you are 50 and above. Those are called catch-ups. So now that's $31,000. For 2025, you could contribute up to $70,000 to your 401k, right? That includes employer contributions and after-tax contributions and your salary deferral. So salary deferrals, after tax, and employer contributions, if you add all that up, that is $70,000. And if you are 50 and above, then you have an additional $7,500, bringing your total to $77,500 in your traditional 401k. Now, just like traditional and non-traditional IRAs, your regular 401k is susceptible to required minimum distribution. So at age 73, got to take that RMD. Now, once you have maxed out your salary deferrals part of your 401k contributions at $23,500, then you can start contributing after tax. So more than likely that your employer-based 401k has an employer match. So your employer is then making their contributions, and then the rest is the after-tax bucket. And this is where you can contribute to your 401k, not allowing for a pre-tax deduction, and you can contribute after tax and fill up the rest of the bucket all the way up to $70,000. And again, if you're 50 above, then you have an additional $7,500. Now, that after-tax contribution is where you can participate in a mega backdoor Roth strategy, because Roth IRAs have a income phase out. So if you make too much, you cannot participate into a Roth IRA. On top of that, they have contribution limits. Now, if you have a 401k and you can contribute a large amount to that after-tax portion, maxing out your 401k entirely, now you can roll over those large after-tax contributions that were made to your 401k into a Roth IRA using the mega backdoor strategy. We have a show on the Life Money Balance podcast about mega backdoor Roths. We also have a blog on the Concurrent Wealth website, so go check those out. Now, this is a good time to pivot to Roth IRAs and Roth 401ks. And as I mentioned, Roth IRAs have income participation phase outs, where if you make too much over an income threshold, then your contribution ability to a Roth IRA begins to phase out. And then once you hit the max of income, you can't participate at all, right? Those phase outs begin for single filers at $146,000, and for married filing jointly is $230,000 for 2025. Now, Roth IRAs are generally for younger investors that are at the beginning of their careers and making lower salaries. That said, lower salaries, right, can go all the way up to, right, $146,000 for single filers and $230,000 for married filing jointly. Now, here's some key characteristics about Roth IRAs. Roth IRAs are not susceptible to RMDs. Also, you contribute after tax, so you don't get a tax deduction. Roth IRAs grow tax deferred in the middle. And then a big benefit is when you take money out. So retirement income withdrawals are withdrawn tax free. Now, one key caveat of a Roth IRA withdrawals being tax free is that the account has to be open for 5 years or longer. And also you have to be over 59 and a half. And that's what traditional IRAs, as far as the age requirement too, 59 and a half in order to take withdrawals from your 401ks, traditional IRAs, Roth 401ks and Roth IRAs, that 59 and a half threshold. Because if you withdraw monies before 59 and a half, you require a 10% penalty on those withdrawals. So let's jump to those Roth 401ks. Roth 401ks are cool because they are not susceptible to RMD. You can contribute after tax, so no tax deduction upon your contribution, but they do grow tax deferred in the middle. And then, like the Roth IRA, Roth 401k distributions are tax free. So if you have a Roth 401k at your employer, then you can participate in those tax-free withdrawals at retirement by not having the income limits and the contribution limits that are on the Roth IRA. So having access to a Roth 401k at your employer is a great way to get large contributions into an after-tax withdrawal vehicle and thus diversifying your account types. All right, now that we've covered the basics of the type of accounts, what are some of the biggest mistakes and the pros and cons of some of these accounts? Well, the pros for a Roth 401k account is that you can participate into a Roth mechanism and getting access to tax-free withdrawals in the future by working around the contribution limits and the income participation limits of a Roth IRA. That's the biggest pro for Roth 401k accounts. Now, one of the biggest drawbacks is that you do not receive a tax deduction for your contribution to the Roth 401k because it's after tax. So you don't have access to reducing your high income salary when you are making contributions to your Roth 401k account. Along with 401ks in general, is that the investment options sometimes are limited. That said, there are self-directed brokerage accounts inside of 401ks accounts that you can utilize in order to open up the investment choices in your 401k packages. Now, for the IRAs, pros and cons, right? For the pros, obviously, for your traditional IRAs, you get a deduction for the contribution. Non-traditional, you do not. You get tax deferral in the middle. That said, you're taxed at the end as far as withdrawal is concerned. Now, when you're talking about Roth IRAs, sure, you can contribute and get access to tax-free withdrawals. That said, there are income limits that we discussed and also contribution limits. So getting small amounts into the Roth IRA is different from participating in a Roth 401k and getting larger amounts into those accounts. And what about the pros and cons of a after-tax contributions in your regular 401k? Well, after-tax contributions, first of all, you get to participate in your salary deferral elections, right? So your salary deferral elections allow you to get a deduction for those contributions up to $23,500. Then you have catch-ups at $7,500. And then you have your employer contributions, then your after-tax contributions. Those after-tax contributions can then be rolled over through the mega backdoor strategy into a Roth IRA. Now, that after-tax contribution and rollover using the mega backdoor strategy is also kind of a con as well, because there are a lot of mistakes when rolling over after-tax money into a Roth IRA. Sometimes the pro rata rule is triggered to where if you have existing traditional IRAs, the IRAs are aggregated. If you have taxable amounts during those rollovers, that means even though you did not have any gains on the amount that you contribute to your after tax. If you do it immediately, you have untaxed amounts in other traditional IRAs, and that tax is going to be triggered on the pro rata untaxed amount in your other IRAs. So having a clean IRA strategy is real key when you're contributing after tax to your 401k and rolling over to your Roth. What you want to do most of the time is when you have traditional IRA balances, if your 401k allows it, enroll those amounts back into the 401k so you don't have any pro rata exposure when you're taking advantage of a mega backdoor Roth. And lastly, some of the biggest mistakes that I see are contributing too much to your Roth IRA accounts, and then that will have a penalty if you don't withdraw those amounts over the amount in time. Also, the pro rata rule, which I mentioned, when you're taking advantage of the mega backdoor strategy, not rolling over your after-tax contributions to a Roth IRA immediately so they won't have any gains, and leaving after-tax balances in regular 401ks, which would trigger RMD. Now let's round out the show and see which type of accounts are better for whom, and is there a combination of account or one account, right? Well, for you high income earners, you have high income W-2 earnings, and you want to not only save and max out your retirement savings so you'll have a lot for retirement, you also want to reduce your tax obligation. So a regular 401k is probably best for you because you get to participate in salary deferral up front. All right, maxing those out to $23,500. Then you have employer contributions that you receive. All right, if you're 50 or older, you could have an additional $7,500. And then you can have those after-tax contributions, right, that you can then roll over to your Roth IRA. So you have a combination of using your regular 401k, getting a tax deduction, a tax deferral in the middle, and then using your after-tax, rolling those over immediately into a mega backdoor strategy and getting access to tax-free withdrawals using a combination of a Roth IRA. And on top of all that, you avoid requirement minimum distributions using that strategy by rolling over all of your after-tax amounts into a Roth IRA. And as mentioned earlier in the show, if you're a younger investor saving for retirement, Roth IRAs work, even though they have lower contribution limits, but they also have lower income thresholds. So for those younger persons that are the early careers, a Roth IRA or a Roth 401k is probably the most optimal. Now, for you higher income earners over the Roth IRA income thresholds, you can utilize your regular 401k to get a tax deduction for your salary deferrals, use those after-tax contributions to get it into a Roth IRA using a backdoor strategy. Also, not all 401ks have a self-directed brokerage option, which would expand your investment options at your employer. So getting those monies into an IRA that you can control with a vast amount of investment options, almost unlimited, into that IRA will give you more investment choices. All right, that's what we got for you. If you want more detail, jump on over to the Concurrent Wealth website. Check out the blog that we have on this topic. Not only that, we have a blog on the backdoor Roth strategy and a show on that as well. And as always, if you like what you see, feel, and hear on this show, like and subscribe and share with your family, friends, and colleagues. Until next time, we'll chop soon. Cheers.